If you've got a mortgage and some equity left over in your home, here's an expert level strategy on using a HELOC and 0% credit card stacking to accelerate your mortgage payoff. Most people stop at using a HELOC alone for accelerated or velocity banking. Add 0% credit cards into a stack correctly and you can stretch the float window from about a month to well over a year, attacking your mortgage from two angles at once. Now, let's get fair up it. The two tools quickly. Strategy overview. A HELOC is a revolving line against your home equity. Critically, its interest is calculated on your average daily balance, not a monthly snapshot. A 0% card or a stack of them gives you an introductory rate lasting 12 to 21 months. Used together, they attack your mortgage from two different angles at the same time. So your HELOC, revolving line secured against home equity, interest calculated daily. Every dollar lower saves you money. 0% cards, introductory rate lasting 12 to 21 months. Depending if it's a personal or a business card, we can run a double stack. That's 5 to 6 personal cards, 5 to 6 business cards within a 10-minute window to get them all approved. Delays cash outflow and extends your float window dramatically. Combined power, living expenses run through the cards. Every dollar of income goes straight to your HELOC balance. Now, the chunk, step one, making the lump payment. Say you're carrying $200K mortgage and you have access to a $40K HELOC. You take that $40K and make a lump principal payment against the mortgage. The balance drops to $160,000 and you've just skipped ahead on the amortization schedule significantly, cutting future interest on that chunk immediately. So starting balance, $200K mortgage principal, lump sum $40K paid via HELOC, you max it out. Reduce mortgage balance, $160, faster amortizer. Now, amortization schedules are front-loaded on the interest, so you're skipping ahead of that front-loaded curve. This single move eliminates years of scheduled interest payments by compressing the amortization curve at the front end, before the HELOC balance even becomes the focus. So, step two, why the HELOC balance matters now. The balance moved, not disappeared. That $40K didn't vanish. It transferred onto a HELOC. Because the HELOC calculates interest daily, every single day that balance sits lower costs you less. The mission from here. From this point forward, the entire goal is crushing that HELOC balance as fast as humanly possible. Every dollar directed at it reduces your daily interest accrual in real time, unlike a traditional mortgage's monthly calculation. So daily interest calculation means speed of paydown has an outsized impact on total cost. This is where the 0% cards come in. Now, it's crucial understanding that your personal 0% cards maxed out will tank your FICO because utilization makes up 30% of it. However, business cards can be maxed out for the entire introductory period, no impact to your personal credit. A basic version of this strategy uses a regular credit card's grace period, typically 21 to 30 days, to delay pulling cash back out of the HELOC. Swap that for a genuine 0% introductory card, and you stretch that same flow from about a month to 12, sometimes 21 months. Income arrives. Every dollar of income goes directly at the HELOC balance, not towards living expenses. Expenses on the cards. Living expenses run through a 0% card, creating a long float with zero interest cost. HELOC drops fast. With income hammering the HELOC and nothing pulling it back up, the balance falls dramatically. What that actually does to the balance, instead of a 1 month float on a regular card, you're now running 12 to 21 months where your income is hammering that HELOC balance with almost nothing pulling it back up. The $40K chunk that moved onto the HELOC can get cleared dramatically faster, often well before the 0% window in the cards ever runs out. 1 month, regular card float, standard grace period on a typical credit card, minimal impact on the HELOC paydown speed. Whereas a 12 to 21 month float of 0% introductory period that keeps income fully protected at the HELOC balance, now you've got a chunk cleared. The lump HELOC balance can be eliminated well before the 0% window even closes. And here's the risk management, the exit plan you need before you start. Think about that. You've now got a cleared HELOC. You could attack the principal on the mortgage again for another $40K, bringing it down to $120. What's that going to do to your monthly mortgage payments? Before you start this, know exactly when each card's introductory period ends and have a real plan for that date. Your three options: pay it off in full, roll the balance to a fresh 0% offer, or draw briefly from the now much lower HELOC to clear it. What you cannot do is let a card silently flip to its standard rate, which often runs 20 to 30% or higher. Pay in full. Clear the card balance entirely before the intro period expires. Roll to new offer. Transfer the balance to a fresh introductory card before the deadline. Draw from the HELOC. Use the now reduced HELOC to clear the card if needed. A last resort with lower balance. Or if your income can manage it, smack that principal on the mortgage again with the 40K on the HELOC. If the equity in the home's gone up, you can now actually extend the HELOC. Maybe you could turn that into a 70K HELOC. The trap, 0% APR versus deferred interest. Choose 0% APR card. No interest accrues during the introductory period. If you carry a balance, you only owe what you spent, nothing retroactive. Deferred interest financing, on the other hand, says no interest if paid in full by a certain date. Miss that date and you get hit with all the back interest at once, often at a higher rate on the full original balance. Confirm exactly which type of offer you're holding before this becomes a core part of your plan. The difference between these two products can cost you thousands if misunderstood. Discipline required. Big warning. The discipline problem. Here's the part that quietly wrecks this for people. Spending doesn't feel real when nothing's accruing interest on it. And it's very easy to creep your spending up simply because the card feels free. The entire strategy falls apart the moment that happens. The psychology trap is 0% cards create a false sense of free money. Lifestyle creep is the number one silent killer of this strategy. Maybe you go and upgrade your car, you buy a boat, you improve your property, whatever it may be, you buy some toys. What's required? Track your cash flow closely, not loosely. Know exactly what's on each card, when it's due, and what your HELOC balance is at all times. The standard, this is a month after month commitment. If it requires the same rigor as managing a business cash flow, not a casual budgeting approach. Now, why your credit file needs to be strong first. Both of these tools work better with a stronger credit file behind them. Larger 0% offers and a better HELOC terms both depend on your credit standing. This is often why cleaning up existing revolving debt with a term loan comes before any of this. Walking in with a strong file gets you bigger limits and better terms on both tools you're about to use. So pay down revolving credit card debt before you start, term loan refinance, qualify for the 0% offers, and secure a better HELOC. The sequence matters. Skipping the file cleanup step means smaller limits, worse rates, and a less effective version of the entire strategy. So get it set up right from day one. The honest caveat, done right, this is a genuinely powerful way to accelerate a payoff. Done sloppily, it can cost you more than if you just left the mortgage alone. So this is not a strategy for someone who isn't ready to manage it closely, month after month. It requires a HELOC with fast access and genuine follow through on paying down and rotating cards. Done right, powerful acceleration of mortgage payoff, float window stretches from weeks to well over a year. Done sloppily can cost you more than leaving the mortgage alone. Higher card rates and missed deadlines raise all gains. So this is not for the disorganized. How we help structure this the right way. This is exactly what we help structure. Checking first whether your file actually supports this, then setting up a HELOC and card stack to work together deliberately with an exit plan for every card mapped out before a single dollar gets drawn. We use StackEasy.ai or cardstack.money to track all those cards, the cashback rewards, limit increase windows, and the end of the introductory period, rather than keeping a manual spreadsheet like we used to do for clients, which was a nightmare. So we do a file review first, structured card stack, exit plan for every card. We'll walk through whether this strategy fits your mortgage, your credit file, and your cash flow directly with real numbers. Worst case on earth, you walk away with a game plan. Now, here's the strategy at a glance. Make the chunk. Use the HELOC to make a lump principal payment on the mortgage, skipping ahead on the amortization table, extend the float, run living expenses through the 0% cards to keep income, hammering the HELOC for a year to a year and a half, plan the every exit, know each card's deadline, and have a clear plan, pay off, roll, or draw before you start, and stay disciplined, ladies and gents. Track cash flow closely. Spending creep and missed deadlines are the only ways this fails. So, capfunded.com, we're talking days, not weeks. I'm Mick Wadley, the founder. A HELOC alone can accelerate a mortgage payoff, add 0% cards done right, and you stretch that advantage from weeks to well over a year. The credit side of getting ready for this is just as important as strategy itself, and that's where it all begins. HELOC alone accelerates payoff, but the float window is short and the impact is limited without a card layer. HELOCs in a 0% business card stack stretches the advantage from weeks to well over a year, the most powerful version of the strategy. So let's go close something. If you loved this video, if you absolutely adored it, head down, smack the subscribe, flog that bell, and I'll see you on the next one.